Okay. All right, welcome to the show, folks. Jason Bible, Texas Real Estate Mastermind. Rob had to run off to another meeting and wanted me to talk about what's going on in the banking world. So let's review. And I'm going to make this real simple, not because I think the audience needs it to be dumbed down. I just think it needs to be, if you listen to all these business people, they use these big fancy words and all this technical jargon, and it sounds really confusing, and it's really not. It's super simple. And let me explain what's going on. There are a number of financial institutions, not just banks, pension funds, sovereign wealth funds, really big investors that bought safe securities. And let me explain what are safe securities. Treasuries and mortgage bonds. In fact, mortgage-backed securities. In fact, I'm going to do a whole show on commercial mortgage-backed securities because that whole market is imploding right now. But I don't want to get too ahead of myself. I can only cover so many financial crises as they develop. So let's talk about the one that's hitting the major news right now. The financial blogs, you're hearing a lot of stuff about the commercial side. But let's talk about mortgage-backed securities, the residential ones. So treasuries are considered really safe, and so are mortgage-backed securities. They are some of the safest investments according to the federal government that a financial institution or an individual investor can make. And that's true. Treasuries, you don't ever have to worry about losing your money. The Treasury does not go bankrupt. I mean, we can argue maybe it is bankrupt, but from getting your principal back, the U.S. government's always going to be there. Mortgage-backed securities work almost the same way. In fact, if you're investing in what's called a QM mortgage, a qualified mortgage, those are insured by the federal government. That's why banks and other financial institutions, again, pension funds, wealth funds, big players in the marketplace will offset risk by buying these risk-less assets. So here's what happened. A year ago, rates were at 3%. On a 3% mortgage bond, you'd make about 2%. That's just the rough math. I don't want to get into all the technical bond math because quite honestly, I think bonds are boring and the math is kind of a pain. So you're making about 2% on this mortgage bond. Hey, that's not bad. If I've got a couple $100 billion, 2% isn't bad. But where do I get my couple $100 billion? Well, I own a bank, and that bank has depositors. So those depositors put their money in my bank, and then I take that money and then invest it in really safe stuff. Why do I invest it in really safe stuff? Because I have to, because I'm a bank. That's just, I don't want to get into the regulatory environment and FDIC oversight and all that stuff. Just know that money's got to go into safe stuff. I really can't go in and do speculative stock stuff with it. I mean, you can, but let's just keep it kind of basic for right now. So you bought last year, your Bank Jason Bible, bought $100 billion worth of mortgage-backed securities or treasuries at 3%. Well, what are those trading at now? Well, those mortgage-backed securities are 7%. So the interest rate has more than doubled. Okay, maybe I could put another $100 billion in and get a higher rate of return. You can, but here's the problem. I own all these old bonds at 3%. So what is my bond? If I have to sell those 3% bonds, who's going to buy them? Are they going to buy them at what's called par value, meaning $100 billion? Or are they going to require me to sell them for less, giving them a yield closer to 7%? And the answer is, I'm going to have to take a haircut. In other words, I'm going to have to take a loss to sell those bonds to represent as close to 7% interest as possible. So here's what happened. A couple of banks got into a little trouble, needed to raise cash so they could cover the withdrawals from their depositors. So they had to sell a lot of these notes way below market. This is actually one of the, you hear the term mark to market. That's a real popular term right now. I am not the biggest fan of mark to market accounting, in part because you're making investments for the long term. Now, the problem with what's called mark to maturity means that I could write any number on a piece of paper and say that asset is worth that. Now, in the bond market, it's pretty easy. You bought $100 billion worth of bonds. Let's say they're 30-year bonds. 30 years from now, they're worth $100 billion. That's the maturity, right? So now what's happened? Well, I listened to Janet Yellen's presentation today in front of the American Bankers Association. And one of the things that she said is we are now backstopping not just FDIC insured accounts to 250,000. We're now going to backstop all depositors at all banks. So what does that mean? Well, now our FDIC insurance fund is backstopping $18 trillion in deposits. $18 trillion. I think that's like 30 Afghan-Iraq wars. I mean, that's how big that number is. 18 trillion. Why are they doing that? They're trying to save the banking industry. So the other thing they did is they opened up lines of credit. This happened on Sunday night, Monday morning. So essentially, banks can now borrow from the Federal Reserve. And not only that, but the Federal Reserve and the other central banks are borrowing cash back and forth to each other. This should sound really familiar because this is quantitative easing 101. Interest rates haven't gone down yet, but we are in a, don't make any, I'm not one to freak out about stuff, but I will tell you this. We are absolutely in a financial crisis. That is what this is. By definition, it's financial crisis time. We are in a banking crisis. Do not discount that. I heard Logan Matamashi talk about it today. We are technically when the Federal Reserve has to step in, the FDIC and Treasury have to step in to start rescuing multiple banks. That is exactly what is going on. There are a lot of financial institutions. There's a report came out Wednesday or Wednesday last week or Thursday, I can't remember. These gentlemen did a quick study. Had to make some assumptions, but they did a quick study and they said, hey, there's over 250 banks in the United States that we believe are in real trouble. If they had a certain number of their depositors come in and ask for their money, they would sell assets and there would not be enough assets to sell to cover those deposits. This is the consequence of raising rates too quickly. Did rates have to go up to curb inflation? I don't necessarily agree with that, but modern economists would say, yeah, we need to increase rates, slow down business a little bit, allow the supply chains to catch up, and that would lower inflation. But you don't have to raise them that fast. When you raise them that fast, it doesn't allow these other financial institutions to, I'll use this term in quotes, reprice their risk. The whole case study behind Silicon Valley Bank is very interesting. Their chief risk manager left in April of last year. What was happening in April of last year? Rates were going up. And I think she could see, I don't know this to be true, but I think she could see the writing on the wall because the analysis is called VAR, value at risk. It's a very common tool used in finance. And I'm willing to bet she sat down, did a little value at risk calculation, and basically said, guys, we will be insolvent if we have X number of outflows of deposits at Y interest rate. And here is where I think the percent likelihood based off what the Federal Reserve has said and how they're going to raise rates on when that's going to happen. That's called a value at risk calculation. Basically, how much money are we going to lose? When are we going to lose it? And how likely is that to happen in the next 6, 12, 18, 24, 36 months? That's what that tool is for. So That's what we're experiencing right now. The Federal Reserve has stepped in. Treasury has stepped in, said, we're going to backstop everybody. Thanks for listening to the show, guys. We're going to have a short message after this breaks. Jason Bible, Texas Real Estate Mastermind.